Welcome to China Currents, your weekly news report on the latest developments in China. I'm Chris, and in this episode, China prepares for potential war against the United States. On March 4th, Trump announced an additional 10% tariff on Chinese products on an original basis. China immediately announced an additional 15% tariff on a number of U.S. agricultural products, including soybeans. Reuters points out the tariffs are broadly negative for U.S. agricultural markets. It is going to have a bearish influence on prices. There are enough corn and soybean supplies in the world for China to make a switch. It is more of an issue for the U.S. because 30% of U.S. soybeans still goes to China. The U.S. will sow what they reap. On February 23rd, China unveiled its #1 central document for 2025, emphasizing the critical goal of strengthening self-sufficiency in domestic food production. The objective is clear: to prevent the United States from launching a second food war. The U.S. initiated the first food war against China in 2001. Though China ultimately prevailed, the staggering cost was unforgettable. Prior to joining the WTO in 2001, China faced relentless U.S. opposition. A key U.S. demand was unrestricted access to China's grain market, particularly for wheat and soybeans. With the U.S. holding veto power over China's WTO bid, Beijing faced a wrenching dilemma: reject the terms and forfeit WTO membership, which is critical for industrial growth and job creation, or compromise. China, home to 18% of the world's population but only 7% of its arable land, prioritized safeguarding staple food security. Reluctantly, it opened the soybean market while protecting wheat, a strategic trade-off. Soybeans, though essential for cooking oil and animal feed, were deemed less critical than wheat, a dietary staple. By 2003, surging demand drove imports to 18 million tons, surpassing domestic production. The U.S. Department of Agriculture repeatedly claimed that droughts have reduced soybean yields, causing global soybean prices to soar from $300 per ton to $600 per ton. As prices kept climbing, the USDA announced in 2004 that it would not increase soybean production, pushing prices past $750 per ton. This sparked panic among Chinese soybean oil companies, which rushed to sign massive purchase contracts with American grain traders, fearing prices would rise even further. But shortly after these deals were sealed, the USDA suddenly declared that its previous data was inaccurate. Following this news, global soybean prices plummeted back to $300 per ton. And for China, this was disastrous. The price manipulation wiped out many Chinese companies. Meanwhile, American agribusiness giants swooped in. Before the soybean war, China had about 1,000 soybean processing companies. By 2006, fewer than 30 remained, and over 70% of China's soybean trade was controlled by the U.S. The USDA's plan was even more insidious. It inflated soybean prices during China's planting season and then crashed the market during harvest time. Chinese farmers bought expensive soybean seeds at high prices only to lose all their money after a year of cultivation. This deliberate timing targeted China's poorest farmers, infuriated Beijing. In 2004, when U.S. traders drove soybean prices to historic lows, attempting to crush Chinese farmers completely, the Chinese government intervened. State-owned China Grain Reserves Group, Sinograin, began stockpiling vast amounts of soybeans, secretly buying both domestic and imported soybeans. To this day, the exact size of Sinograin's 04-05 reserves remain unknown. Had American grain traders maintained a status quo, China's reserves might have stayed dormant. But in 2006, citing another natural disaster, U.S. traders restricted soybean exports and pushed prices up again. This time, China struck back. When prices reached untenable levels, Sinograin began releasing its stockpiles in controlled manner, selling soybeans slightly below market rates every 10 days. And despite Sinograin's moves, U.S. traders continued to push prices higher. China responded by accelerating its releases, shifting from 10 days intervals to weekly, then every 3 days. U.S. traders, undeterred, continued limiting exports to sustain inflated prices. This standoff persisted until the 2008 global financial crisis ravaged markets across Europe and the US, dragging the grain market down with it. Only then did soybean prices collapse. Interestingly, just before the Beijing Olympics, Sinograin announced that China's soybean reserves had become excessive and partnered with livestock businesses to offload the surplus as animal feed. It was like a prolonged stalemate in a high-stakes race. Just as the American driver ran out of horsepower, the Chinese driver rolled down the window and quipped, "Time to shift into second gear." Global soybean prices spiraled downward and U.S. agricultural giants conceded defeat, exiting the race. That victory not only protected Chinese farmers but also benefited U.S. farmers indirectly. When China joined the WTO, the U.S. seemed to suffer a natural disaster every few years, triggering soybean shortages. Yet after China demonstrated its massive reserves, those disasters mysteriously vanished. In recent years, China has expanded its soybean reserves and boosted domestic production. Techniques like intercropping soybeans with corn at optimal spacing have maximized land use and increased yields. Official data shows China's grain production has exceeded 650 million tons for 9 consecutive years, with soybean output stable at over 20 million tons. The United States, burdened by a $36 trillion national debt, has lost its edge over China in factories, battlefields, and financial warfare. Trump once mocked Zelensky for having no cards left to play, but the US itself is down to agriculture and biotechnology in its rivalry with China.